Cool. Skyler just wrapped up with Jacob. This is a great conversation. A lot of fun.
Yeah, it really was. Just to hear his background in real estate, kind of how he started, maybe residential and multifamily, kind of switched to the self storage unit play, right? And why that came to be, and kind of what they're doing today, and obviously all the pros and cons associated with going through that, that
Yeah.
process to where they're at
Yeah, for
current
sure.
state.
We've had a couple fun real estate episodes recently. So this is another one in here for it. But yeah, we dive super deep into self-storage here. Ups, the downs, a lot of the downs, but there's a lot of great stuff here. I thought it was a lot of fun. Jacob's great. He's got a handful of war stories. So um
Yeah, that's always
yeah,
good to hear too, right? The war stories, and then just hearing his perspective on switching from just other people managing to becoming an owner operator and managing the units themselves, and how that kind of changed the perspective and dynamics there. Definitely,
yeah.
we'll get into that in
He's
the
using
episode
AI
here.
and stuff for pricing too, which is cool. So uh
Yep, absolutely.
utilizing technology as you will. Um yeah, this is a fun one.
Yeah, definitely. Let's get into it. Awesome.
Thanks for tuning in to the All Funds Network podcast. My name is Mike Schroeder. Today I'm joined by my co-host Skyler Steinke, and we are also joined by Jacob Vanderslice. Jacob is a principal at VanWest Partners. They are a self-storage owner and operator, and he's based out of Denver. Jacob, thanks so much for joining us.
Thanks for having me on, guys. Good
Good
morning.
morning.
Yeah, good morning.
Absolutely. Well, yeah, let's kick it off. Maybe Jacob, just start, by telling us a little bit about your background, and we'll eventually get into what you're up to today.
Yeah, we've been investing full-time in real estate for, I can't believe it's been 20 years. I think my first deal was plus or minus like March of 2006. And I was in the fire service, had a bunch of time on my hands, and started dabbling in single family residential on my days off, and got busy doing that and quit my W-2 job. And I've been, I guess, gainfully unemployed ever since. We started off with a bunch of residential projects, buy, fix, and sell projects, rentals. Did over 1,000 of those over many years. We got into commercial real estate around 13, 14 with some adaptive reuse retail here around Denver. Did some town developments, some apartments, some industrial. We covered a lot of the real estate bases. And we had looked at self-storage for a while, and we liked the fact that the asset class has been historically downside protected, more durable. And in retrospect, one of the things we did not like about our business looking back is we were kind of overly transactional. We were just buying and selling too often and too quickly. And we thought that storage was a good vehicle to sort of shift our business plan into being more medium to long-term asset accumulators and operators. So we did our first storage deal in 2015. And at the time, it wasn't really an intentional pivot. It was more just, hey, try a deal out, see what happens. And went okay. We did another one. And over time, we evolved into being almost exclusively a self-storage owner operator. We've got 42 assets, about 21,000 units, roughly 3.3 million square feet. Most of the deals that we've acquired over the years are value add existing acquisitions that we just identify with that have some level of inefficiency. Their rents are below market, their expenses are above market. We'll add value by trying to operate them more efficiently than the last guy did. Sometimes we'll do development projects, but they're fewer and further between. Of our 42 property portfolio, we've only built 2 of those. So most of the business is just identifying undermanaged facilities and then adding value with more efficient operations. So that's what we're up to.
So these like self-storage units, there maybe climate control, or have some aspects that you're, something that you could upgrade or change on the property and try to make it better, raise the rents as an example.
Yeah, some of our deals are very capital intensive, like capital improvement intensive. Others are just more of an operational lift. So it kind of depends on the project.
Yeah. And what was kind of the main aspects of kind of getting into self-storage? Obviously, you saw the opportunity. What's some of the things you liked about it, and what did you look for when you first got into self-storage?
Well, why don't we first talk about what I don't like about it, and
Even
and
better.
what the risks are. So there's a common misconception that self-storage is easy. You often hear no tenants, no toilets, no problems. That could not be further from the truth. It's very operationally intensive. On any given day of the week, we've got people breaking into units. We've got U-Hauls breaking or backing into our $30,000 gate systems. We've got folks cooking meth. We've got people just doing bad stuff in their storage units. Those people are good, but the subset that are bad, I mean, we get 21,000 units, bad stuff happens. I would say the biggest risk of the asset class, though, aside from, some of the operational difficulties, is local supply. It's very much a 3-mile business. And you could say that self-storage is oversupplied or undersupplied in a given MSA. But what you care a lot more is what's happening within 3 miles of the site you just built in Denver or the site you might be buying in North Carolina. So very supply sensitive. And if somebody breaks ground, say a public storage comes in and builds a 100,000-foot bomber a mile away from your site, you're going to suffer from an occupancy and revenue perspective for a while because you're fighting for a finite customer base with more supply. Obviously, the classic supply and demand curve. So those are kind of the downsides to it. And,
Actually, before you get into the
main
upsides,
risk,
this is good. I want to keep going with this one.
yeah, I could go all day on the downsides. Let's just have this be a downside conversation. So the other challenge with it, let's say you've got a triple net industrial lease. Okay, then that simply means that the tenant is paying all the building expenses. They've got a rent schedule and a lease, and you can more or less predict your revenue stream within basis points as long as they pay for the duration of that lease, right? It's a very predictable income stream. In self-storage, the leases are not only full service, so obviously the tenants are not paying the building expenses, the taxes, the insurance, the utilities, but all the leases are month to month. And every unit that we have to a degree is its own unique product type. So for example, there might be 100 10 by 10s in one of our facilities. But a 10 by 10 that's right by the front door, more conveniently accessed, is going to command a different pricing algorithm than a 10 by 10 on the third story of the building and a 100-foot walk down a hallway. So point I'm trying to make is predicting your revenue in this business is very difficult. You've got all these product types, you've got month-to-month leases, and depending on the market, you've got seasonality. So obviously up in Milwaukee, where you are, Schroeder, the seasons are much more pronounced, whereas seasonality may not be as pronounced in, say, the Florida Panhandle or Central Florida. So you got seasonality, you got different product types, you've got different unit mixes, unit types, and predicting out your revenue streams and forecasting your revenue streams is the polar opposite from the triple net industrial lease I gave you a moment ago. And the supply issue has been more of a real problem, and it's always been a problem, but it's been more of a downward source of pressure in the industry the last couple of years. A lot of operators had the same idea at the same time back when fundamentals were different and probably better. It takes a few years to get it entitled and get it built. So a lot of folks broke ground in 22 and 23 fundamentals when the market was a bit more robust. And they delivered in 24, 25 into 26 in a materially different environment. So you've got a lot of supply shock around the country. But I would say the main source of downward pressure on the industry overall has been a lack of American mobility the last couple of years. Now, why is that? Everybody probably knows the answer, but I'll give it anyway, at least in my view. It's primarily due, I think, to the speed in which interest rates rose on typical residential mortgages. It's not so much where interest rates are today. I mean, back in the history of interest rates, if you look back decades and decades, we're at a pretty fair and balanced interest rate environment, right? But the speed that it went from whatever 3% to mid sixes or 7, depending on where it's at today, kind of shocked a lot of people. So you have a lot of homeowners who don't want to sell because they don't want to pay off their 3% loan and borrow it again at a 6.5. And a lot of the times they can't afford to sell, not from a proceeds perspective necessarily, but from a monthly nut perspective on the new deal, right? It's like I'm going to pay the same price I'm selling my house for on the new deal, but my nut's going to be, multiples higher than it was previously, taxes, insurance, and obviously the interest rate. So people are not bouncing around the country as much as they used to. Single family residential sales are anemic. I think April numbers just came out and they're not telling a great story. Stuff is still transacting, but it's nowhere at the level that it was before. So what does all this translate to? It translates to people moving around the country less frequently, and it translates to downward pressure on self-storage consumer demand.
I want to whine
To
with you a
keep
little
going.
bit more. So with the, or maybe let's talk about like, who is the typical like user for a self-storage facility? I think like, I mean, to your point, it sounds like people moving. I mean, it's just like, I got a lot of shit in my basement. I need somewhere to put it. Or
Yeah.
is there like other type of like, client base that you see?
Well, you teed this one up in the fairway for me, so I'll give my own personal example. So, we own our office building in Denver. We bought it back in 19. We put some money into it, and we lost our industrial tenant downstairs, and I was keeping a bunch of stuff down there for basically free. Taking advantage of the system, taking advantage of my partners. I had a dozen pair of skis, old mountain bikes, like seasonal gear, bunch of sets of golf clubs that I don't use anymore, like family heirloom furniture, like stuff that I don't want in my house. I don't want to get rid of it. And we got a new tenant down there, so I had to get my stuff out. So I ended up leasing a storage unit like a block away. Unfortunately, we don't own the building, but it was too convenient to say no. And I thought to myself, all right, I'm going to have my stuff in here for a couple months. I'm going to donate it to Goodwill. I'm going to bring some stuff over to my sister's house. I'm going to triage this in a couple months tops. So 18 months later, I was still paying on that unit. My rent had doubled through ECRIs. It's part of the strategy in the industry. You get them in cheap and kind of gradually bring them up over time. And every month it hit my credit card, it would piss me off, but not enough to take action, and it wasn't enough money to put my lights out. So I kept that unit for a year and a half, and I probably spent, I don't know, $5,000 to store $1,000 worth of stuff, if that. And I finally was like, all right, this is the weekend. I'm making the time. I'm getting a trailer. I'm going to go get rid of this stuff, and I did. But that is your typical self-storage consumer. The reason I tell that story, they think they need the unit for not too long. It becomes out of sight, out of mind. They don't want to deal with their stuff, and they end up staying there for much longer than they anticipate. And often they pay a greater figure in rent than whatever they're storing is worth. But as far as our types of consumers, we have a lot of business owners. We have like beverage vendors who will stock all of their beverage inventory in a storage unit, and they come and go multiple times a day. Landscapers, plumbers. You've got folks in our more kind of urban infill locations who might be renting a studio apartment, and they've got a mountain bike and skis, and they need somewhere to put it because they can't fit it in their apartment. Really, our basic demand driver is the consumer moving up and down the economic ladder. So the industry does pretty well when things are getting really good, and it does pretty well when the wheels on the economy are kind of coming off the bus. And largely, in my view, our economy's been kind of stuck in neutral for a while, right? Like you get bad news over here, but then the bad news is balanced out by good news over here. But people are just not making moves like they used to. And I think that's one of the reasons why the industry has kind of been lighter on performance the last couple of years.
Yeah, yeah, very interesting. I guess from my side, Jacob, what I'd see here in the Midwest, obviously in Omaha, Nebraska, there's quite a bit of storage units. You give a military base here, and actually it's been pretty good for those storage unit owners, given everybody's traveling right now, especially in the military. You get shipped overseas. You're just moving to another, station or military base in the U.S. You need to store your stuff, and they pay, you know, every month like clockwork, like you said, and they forget about it a lot of times, and they, have to figure out a way to move it. Military will move your stuff as well, so they're used to paying storage units religiously on a monthly basis. So it's pretty interesting to see. And to your point, real estate agents, maybe staging houses, they have a storage unit as well. They're a lot of those folks are, a lot of business owners. So definitely I could see the opportunity for them. Um, which is pretty interesting. But yeah, maybe tell us about kind of just, we talked about the doom and gloom a little bit. What's the opportunity? What do you see as a positive for types of your clientele they're looking to use storage units or rent from you essentially?
Yeah, I think the main reason we got in the industry is the historic resilience. It's been historically downside protected when things really soften. So, for example, back in the GFC, self-storage loans had the lowest default rate of all the real estate asset classes. And I think the reason that is simply when there's a big macroeconomic displacement event, what happens to mobility? It increases, right? People start moving around more. And if it's for bad reasons, they're downsizing their homes. They might be getting divorced. They might be losing their jobs. they still have stuff they need to keep somewhere. So it's been historically downside protected, and the peaks and troughs in self-storage have historically been less pronounced than a lot of other asset classes. We've had our share of headwinds, believe me, but we haven't seen anything, remotely similar to office. Is obviously easy to disparage. That's kind of an outlier in the real estate asset classes, but multifamily has been pretty beat up too. The last couple of years, a lot of deals gone bad out there. A lot of aggressive underwriting assumptions. A lot of dangerous debt, floating rate debt that eventually went up, with SOFR, and that debt matured, and there's suddenly a problem on a refinance from a proceeds perspective. But it's been historically downside protected. We're relying on thousands of customers to pay us tiny bits of rent every month. So going back to my industrial lease example, yeah, that might be easy to predict, but if you buy a 50,000 foot building and you lease it to one tenant, and that tenant rolls over on you, you get a big problem, right? It's going to take you a long time and a lot of TI and a lot of leasing commission to find a new tenant for that space, not to mention the downtime on servicing the debt and paying all the expenses. Whereas in storage, when one of our 10 by 10 customers rolls over on us, which they do every day, we overlock the unit. We eventually auction the contents if we have to. We broom clean it, and we put a new customer in there that's hopefully going to pay. So you're not beholden to one large user to have your returns and the success of your portfolio come out on the positive side. So those are some of the reasons we like it. As far as the opportunities go, deal flow has been very challenging. And every podcast I get on where deal flow comes up, I'm probably a broken record at this point now for like 18, 24 months. Last year was pretty extreme. We looked as far as like a lack of deal volume. We looked at probably 900 acquisition opportunities. We financially modeled several hundred of those, and we bought one. So it's a very wide funnel at the top and very narrow at the bottom. And that's not from a lack of effort necessarily. And even though capital is difficult to raise, it's not necessarily because it's hard to find money. It's just we're not finding deals that meet our risk-adjusted return requirements. And despite the softening in real estate, the acquisition environment, the deal flow environment is still hyper competitive. If it's a nationally marketed transaction by Marcus and Millichap or somebody else, we'll throw our hat in the ring. But these deals are trading for huge percentages more than we end up coming in with our LOI because there's cheaper money out there. There's a lot of liquidity in the space still. And there's generally kind of a flight to quality where people are, I'm not so sure about multifamily right now, obviously office, but storage has been fairly resilient in comparison to a lot of other asset classes. We want to allocate our capital there. And to accomplish that, we're going to pay, in my view, too much for that asset. So deal flow is challenging. We're seeing micro distress, not macro distress. And by micro distress, I mean somebody who built a facility, say this deal we're looking at in North Carolina. They built it. They started their lease up process. They're not a great property manager. They kind of stalled out on their lease up, and they've got a loan maturity coming up in Q3, and they've got to do something. They're going to lose money on that, but they're not going to lose all their money. We're seeing more of those deals, kind of early stage lease up development projects that have debt and performance problems. But it's hard to go out and say, even though Green Street will say this, it's anecdotally, subjectively hard to jump on the table and say, oh, values are down 25%, right? And to a degree, that's true, but it doesn't feel like that with how hyper competitive the acquisition environment still is.
Yeah. Talk to us about the acquisition of these deals. How are they different from residential or other multifamily opportunities from your point of
if
view?
I could add to this too, the 99-1 is really interesting. Maybe talk about the one deal that you guys ended up buying.
I'll talk about that deal first. And not only is it unfortunate we only bought one deal, but the one deal we did buy was pretty small. It was about $2.5 million in gross capitalization. Our typical deal size is probably closer to 7 or 8 million in gross capitalization. So it was kind of a tiny guy. The reason we bought that one, we got that through a broker relationship, and I'll expand on kind of how we source deals in a moment. But we bought that one because we built a pretty large development project about 5 miles east of this site. It's in a town called Longmont, just north of Denver. So we had some scale already in that submarket, and debt by no means makes a bad deal good, but it makes a good deal better. And one of the attractive aspects of this deal, which we've seen more frequently lately, is the seller owned it free and clear. And we negotiated a seller carry at a 10-year fixed rate interest only payment. I think the rate was about 6%. Leverage was in the mid 70s loan to cost. So when you look at the debt environment out there, if you're going to go buy something on a bridge loan, you're probably pricing at SOFR plus, I don't know, 300 basis points approximately. So your rate's probably a point higher than that debt term. But when you've got fixed rate interest only financing at a pretty attractive rate, that certainly helps those good numbers become better from a cash on cash return and IRR and multiple perspective. So that one was a bit unusual in terms of the size and also the seller carry. But as far as how we source acquisitions, most of our deals come from off-market sources. And I use that phrase very carefully because off-market to me may not be off-market to somebody else. And by off-market, I mean nobody else has seen it and hasn't been publicly available for sale. And most of these off-market deals come from broker relationships that we've done a bunch of transactions with over the years. So they'll bring us a deal. They feel like it's in our wheelhouse. They'll give us pricing guidance and we'll tell them if we can hit that pricing guidance or not. And if we can, then we proceed and we close on the acquisition. A handful of our deals the last few years have been publicly marketed, but it's very rare we can compete. We also do a little bit of direct to seller marketing that we kind of took from our residential fix and flip days, like a direct mail piece saying, hey, we want to buy your storage facility. We're not brokers, we're owner operators. Give us a call. We might be able to pay you more than you might think your property's worth from a cap rate perspective. So most of it comes off market through broker relationships, some direct to seller, and then occasionally we'll win deals that are a full public offering process, but those are pretty few and far between.
Got it. Very cool. When it comes to, let's talk about the operation side of the business. You mentioned, operations matter more than people think. Kind of how do you think about, operating these facilities? You mentioned things like meth and, on the bad side, meth and people stealing and, talk about the operations of these businesses. This is obviously much different than, residential or maybe commercial.
Yeah. As good as our ops team is, operational excellence is a unicorn that we'll probably never get to. You can always do better. Operations is one of the most difficult aspects of real estate investing. Back when we first got in the business in 2015, we didn't know what we didn't know. And we outsourced our management to some of the larger publicly traded self-storage REITs. And when we were honeymooning with them, we were dazzled with their revenue management algorithms, their marketing, their branding, their back office technology, their call center. And after the honeymoon was over, we started realizing that our interests were kind of misaligned. There's a lot of ancillary income streams in the self-storage business, like specifically tenant insurance, that the larger REITs will keep and not share with third-party owners. And when we look at our income statements, we think, man, there's a lot of money going to them and not a lot of money going to us as the owner. And because of that, we formed our own management platform about 10 years ago, which is called Clear Home Self-Storage. And we slowly started taking our deals back from the REITs and then self-managing everything that we bought thereafter. And I think one of the reasons that we've survived, to a degree, thrived in a very difficult environment is the fact that we self-manage. It took us a long time to figure this out, and it's a pretty simple concept, but big surprise, third parties don't care about your deal as much as you do, right? I mean, I know it's shocking, but a third party is not going to fight over that $1,000 HVAC invoice that you got. A third party is not going to rebid landscaping and snow removal contracts. A third party is not going to protest property taxes as aggressively as an owner will. And a third party is just going to say, oh, yeah, insurance premiums are going up. That's how it is. They're not going to go bend over backwards to rebid the entire portfolio and even save some money year over year on your insurance premiums when the rest of the world is seeing spikes in insurance premiums. So we self-manage simply because we can control that vertical and control the outcome of our portfolio's performance. People say you got to buy it right. You hear that on all kinds of podcasts, and I get what that means. You got to buy it right, whatever, cheap price per square foot or buy it at a high cap rate. But I would argue that operating right is more important than buying it right. You can salvage when retrospect might be a poor acquisition decision, you can salvage that deal with operational excellence, or at least the pursuit of operational excellence. So that's why we self-manage. And it's a pain. We have almost 90 wonderful teammates in our operations team. But it's a challenge dealing with customers, repairs and maintenance, all the issues I described a few minutes ago. But again, we control that vertical, and we're not relying on a third party to give us a P&L 30 days after the end of the month to find out how we did. We know how we're doing real time.
Yeah. And I guess are these people on boots on the ground in those locations servicing those units, or is it just kind of a high level 90 people focusing on, security, all the different aspects of collections, leading all those aspects there in real time?
Yeah, in our Denver office, again, I feel like a bigger deal than I actually am when at our corporate office, right? And I guess that's kind of how we've evolved, even though we don't feel that way. But here at HQ, we've got legal, we've got tax folks, accounting, we've got a controller, we've got HR people. But most of our employee count within Clear Home are regional managers who oversee different submarkets around the country. And then our on-site managers, they're our boots on the ground in the leasing office. They're the folks when you walk in, they've got the Clear Home polo on. They're interacting with customers on site, and there are eyes and ears on the ground to identify and solve problems. We've experimented over the years with more remote management. There's a lot of companies who have found success with this, and we found that 100% remote managed facilities really degrade the customer experience. And you just can't spot somebody breaking into a unit or a dirty toilet as easily if you don't have eyes on it all the time, right? So almost all of our facilities are staffed full time. We do have some satellite locations that might be a mile or two away from a larger facility. That specific site is not staffed full time, but if you want to lease a unit there, you can either do it online or you go into the larger site and walk into the leasing office. But our personnel is critical. And if you look at our Google reviews, what you'll never see is a positive review because of someone's technology. Like, oh, they had great AI, they had a great website. What you'll always see is Darlene helped me find my unit when I couldn't find it. Or Chris helped me reset my gate code when I forgot my gate code to get into the facility. Those positive reviews and the positive feedback is always about a human interaction and not a robot or website interaction. So the staff component is really, in our view, it's important to the customer experience.
How I assume maybe these tie together, but what are the biggest challenges of running a self-storage facility, and also like just getting, because I assume these probably tie together, but like getting new clients. How do you guys go about like the sales aspect?
Yeah, I guess staffing is one of the biggest challenges we've seen, and it's just like any real estate asset class. It's market by market. Like there are some markets where we can't throw enough money at somebody to get them to come back to work the next day, right? They'll get like a $3 an hour upgrade to the Amazon warehouse across the street. We'll never hear from them again. Other facilities, we inherited a lot of these folks from prior owners, but other facilities, we've had teammates working at these sites for 10 plus years. So staffing is a challenge, but staffing is not, I say it's important to the customer interaction, and it certainly is, but staffing is, if somebody doesn't show up to work, it doesn't cease your operational platform, right? It's not like Starbucks where, like, if the Starbucks workers don't show up, right, you can't get your coffee in the morning, right? There's not any way to, get your mocha made. But in self-storage, our customers can interact with us and do every aspect of the leasing process remotely. Obviously, that's not earth-shattering. We all expect that these days. That's not like a cool thing, but if they don't want to interact with a person, they can do it on their phone. They can talk to somebody in our call center. So even though staffing is a challenge, if we have somebody who doesn't show up to work that day, it doesn't stop the gears from turning as far as the operations of that site goes. But retaining staff has been a pretty major challenge. And I would say, a big surprise here, we've seen a lot of pressure on bottom line operating expenses, right? As we all have in our businesses. Utility bills have gone through the roof, property tax assessments, even though we protest them. We have a lot of deals that getting assessed for more than our purchase price. And we didn't buy these things that long ago. So bottom line expense pressures and just our vendor contracts, really trying to keep those under control. Everything just costs more, right? Cost of doing business is worse than it's ever been. I'm sure you saw the inflation numbers this morning. A lot of that's obviously because of the rise in gas prices, but it just kind of keeps going, right? So bottom line pressure and staffing, I would say, are kind of main operational challenges beyond the occasional meth lab and theft and break in.
Let's talk a bit about, I guess, from a raising capital perspective. Are you raising capital from investors to acquire these deals? What does that look like for you?
Yeah, we we have over 450 unique investor positions across our portfolio. Most of those are in one of our 3 closed-ended fund vehicles, but we have a fair number of single asset syndications. Our capital base ranges from the $50,000 self-directed IRA that a dental professional might invest with us through, all the way up to CEOs of publicly traded companies. We have some institutional partners, we have some family offices, but our capital base kind of runs the gamut. I would say our average check size is probably around 250,000, somewhere in there, but we have a lot of outliers kind of in both directions. But capital raising has been increasingly challenged, which I'm sure you guys hear about often, and maybe you're seeing it in your own business the last couple of years. Investors are not incorrectly, but they're perceiving more risk in the environment than there's ever been. And in conjunction with that increase in risk perception, they're seeing lower targeted returns than, say, we were marketing back in 2021, right? And why are return targets lower? Well, leverage is lower, right? So your equity denominator in the deal increases. You're putting more equity into the deal. And the cost on that leverage has increased, right? So you've got lower leverage at a higher interest rate. Inherently, that's going to degrade your returns on equity from an IRR, a cash on cash, and a multiple perspective. So investors are perceiving higher risk and lower return. So what are they doing? Well, they're buying stocks. Obviously, look at what the S&P's done. Look at what the Dow's done. People are just not sure what to do now. So I guess I'll plow it into public equities, and everybody else is doing the same thing. That shoe's going to drop, I think, eventually. It has to, right? It can't keep going up. It goes up till it goes down. But capital raising has been very challenging from our traditional retail investors all the way up to our institutional multi-billion-dollar joint venture partners. They are all reluctant right now to take risk, and a lot of people are taking kind of a wait and see attitude. What's going to be the catalyst that causes investors to get some clarity? Your guess is as good as mine. But the catalyst has not arrived yet.
Yeah, for sure. I totally agree with you. It seems like the market has been melting up for the last few weeks. Been very hot. Ever since, I don't know, Iraq war kind of brought things down. Now it's up, but yeah, it's obvious place to go is equities. But how do you see self-storage units kind of fit into a larger portfolio for folks?
Yeah, let me make a comment on equities first, which I am entirely unqualified to comment on. I'm barely qualified to comment on anything, but especially equities. Like you guys, I listen to podcasts. There's one really smart guy I know puts on a podcast, and he might as well be like a PhD economist. And this is not news, but he's pointed out that the stock market has been at this level of valuation in the history of the stock market for 1% of the time. This is a historic high valuation on fundamentals, PE ratios, EBITDA multiples, you name it, and it keeps going. So we're all watching that very carefully, and I certainly don't wish ill will on the economy, but it seems like it's got to moderate at some point in the foreseeable future here. And that could be a positive for real estate people, potentially, right? Kind of a rotation from equities into alternative asset classes. But as far as what's next for storage, I'll give you some incorrect forward-looking assumptions. Our portfolio performance has been relatively good despite the headwinds. Depending on how you look at it, our same store, or I should say what vehicle you look at, our same store revenue and NOI Q1 to Q1 is either the same or positive, right? So it's not going down. At least we're kind of staying even. And we were at a conference in Napa a couple of weeks ago and getting feedback from other operators, and a couple big guys who have been in the industry for 40 something years were just going around talking about the notion that they have never seen it this difficult and this bad. And these are guys who have done hundreds of transactions, have huge asset bases. So famous last words, how much worse can it get? Right? Yeah. Let's load up, and it can't get any worse than this. And then lo and behold, somehow it does. But we are seeing signs of improving fundamentals. That the Q1 REIT numbers just came out. And for the first time in many quarters, there's some positive velocity from a same store revenue, occupancy, NOI perspective. Again, this is a macro view. What you see happening in the country matters, and we track it, but we track a lot more what's happening within 3 miles of Shelby, North Carolina, right, where we have a site. So I think there's going to be some better acquisition opportunities coming up as some of this pain works its way through the system. I don't see interest rates moderating anytime soon. And I can't believe I'm finally surrendering to this notion. I mean, back in 24, the one-liner for us and a lot of other operators were survive to 25, right? Survive to 25. Well, we got to 25, we survived. And then here we are in 26, and shit, it's not much easier. If anything else, it's more difficult. Look at bond yields, right? Going back to interest rates, bond yields are going up and to the right. And people aren't talking about bonds enough from the interest rate perspective. They're talking about what the Fed's going to do. Well, the Fed doesn't control bond yields. The Fed controls short-term rates. And we care a lot more what's happening with long-term rates in the 5 and the 10-year bonds. Because why? Those are tied to cap rates. Those are tied to our term debt borrowing costs. And they're also correlated to the 30-year mortgage, right? 30-year mortgage follows the 10-year treasury fairly closely. And if we're talking about an affordability crisis in the single family home market and a lack of transaction volume, that's going to only get exponentially worse if that 30-year mortgage goes up to a 7.5 from like mid to high sixes, wherever it is today. So I think this is all going to create some opportunity. When that's going to arrive and how we're going to know it's here remains to be seen. But the problem with market troughs, in my experience, is when the trough hits and you're in the trough, you're just scared, right? You don't know what's the trough. How much deeper can it go? Like, remember 08, 09, you guys are probably doing deals back then, or at least you were familiar with the GFC. Back then we were transacting a lot, and we were just getting in and getting out thinking, oh man, how much worse can this get? Little did we know, 2-3 years later, we're like, oh man, we should have bought everything and held on to it. So when you hit the trough, you're scared, and you don't know the trough hit until years later in the rearview mirror. It's like, okay, that's when it bottomed out. Are we in a trough now? Maybe. That's not helpful, but maybe. Time will tell. The rearview mirror will tell us the story.
Yeah, it's I have a lot of similar thoughts on the macro side of things. It's like I watch a lot, like I do a lot of charting, and there's it's just like somebody that's only been in the market for the last 20 years really hasn't seen a bear market. There's a lot of us. And it's at a certain point the market will at a certain point the market will consolidate for years, which is something that it hasn't done. It's just been up and to the right, to your point. And same with these bond yields. It's as I think about expanding my real estate portfolio, I think about if hypothetically yields, I mean, there's no ceiling. It could be 10% in a couple of years for all we know. How does that affect the value of housing? So it's well, not a big macro podcast, but it is something I'm thinking about. So your thoughts here are on point.
Well, if you indulge me a little bit more in the weeds on that thought, so we'll come right back out of the weeds. We'll be really quick here, but those of us listening have heard of cap rates, and at least at a basic level, we understand that cap rates and values have an inverse relationship, right? It's like an EBITDA multiple. So the lower the cap rate, the higher the value. So when I mentioned earlier that cap rates are correlated to the bond yields to a degree. So let's go back to my triple net industrial example from a few minutes ago. So let's say you buy an Amazon leased building. Amazon's going to pay you, right? You can predict that revenue stream. So you're going to pay a very high value and a very low cap rate for that lack of perceived risk. You might pay a 5 cap for that building, right? The equivalent of an unlevered 5% unyielded or unlevered return on your cost basis. Now, bonds arguably are a risk-free return, right? That's a whole other podcast right there, but they're a risk-free return. If bond yields go up to a 7, what's going to happen to that 5 cap industrial deal? It's not going to be a 5 cap anymore, right? It's going to be an 8, right? it's very low risk, but it's not as low risk as bond yields. And if you do the math on that, that is a cataclysmic decline in the value of that building going, say, from a 5 cap to an 8 cap. So if bond yields are going up and to the right, to your point a moment ago, what's the corresponding impact going to be on real estate values and on real estate that trades on a multiple of the income stream it produces? That's something to watch for. But again, time will tell.
Yeah.
For sure. I guess from a micro perspective, Jacob, obviously we talk about some economic and macro headwinds here, obviously, but from a micro, opportunity perspective, what do you see? Any interesting trends or opportunities you're seeing? Um, Obviously you've been in the space for a while as operators, maybe more resilient than most who just trying to get into the space potentially. What are your thoughts there?
Well, my thought as a 20-year real estate investment veteran is I'd rather be lucky than good. And sometimes you cannot figure out why a deal went better or worse than you thought it would. You can look at all the data, like what the hell, what happened to this thing in both directions. As far as submarkets that we like a lot right now for storage, submarkets that have gone pretty well, we hopefully no storage developers are listening to this. And even if you are, it's probably impossible for you to build a project in the great city of Denver, just given our regime that controls the building permit department. But we delivered a project in Southeast Denver last July. And we never would have dreamt it would have done this, but we've gone from obviously 0 occupancy when we open it up to almost 80% today. And we modeled 80%, I think, on like month 30, and we're not even 12 months into the operations period. Other markets that have gone pretty well for us are some sleepier submarkets outside the
Actually,
Charlotte
but sorry,
MSA.
before you get into that,
Towns like
the
Hickory.
Denver, what do you think happened there?
Well, first of all, it was a knife fight to get this thing approved. It took us 2 years to get it entitled. It took us 2 years to build it. We delivered it like 9 months late. And I take blame when blame is due on us, but 6 of that 9 months was 100% because of the city. No offense, Denver, if you're listening. God bless you. Don't raise our property taxes anymore, please. But the barriers to entry, specifically in Denver, for development, especially new self-storage development, could not be higher. So when we talked about supply risk earlier, supply shock, that's your main risk in the industry. It is unreasonable that anybody could replicate this project within 3 to 5 miles of our site for a rational return. And I think one of the reasons it went well too is we built it in a submarket with very strong densities and income demographics and high traffic counts. Again, I'd rather be lucky than good. I mean, so far it's gone great. I could be crying to you if we record another podcast in a year, like, oh yeah, velocity really petered out on that one, and now we got a loan covenant issue. But yeah, I mean, I could digress too much here, but we all make models in our businesses, right? We're forecasting out future assumptions, and the one common theme of all of our models is our models are always wrong. And I can't tell you how many deals we've modeled out kind of a skinny return because we thought it was a good risk-adjusted return. Like we're gonna take a lower return on this because we think the surety and likelihood that our model will be correct is much higher than on a riskier deal. And those deals have turned out to be some of the home runs, right? You model a 13 IRR and you do an 18. We have other deals over the years that we even dialed back our assumptions and we came up with a 22% return, and that deal ended up doing a 7, right? We still made money, and a 7's not the worst day. It's better than a -7. I'd rather be +7. But the point being is our models are always wrong. And this environment on a macro and micro level, I think the future has never been more opaque. Like we're all making assumptions out next year, 2030 that drive our financial returns. And as a company, we've been a lot more, we've lost confidence to a degree in forward-looking assumptions. And I think one of the outcomes of that sort of loss of confidence has been lower acquisition volume because we price ourselves out of deals, right? If you just tweak that dial over there and pull that lever in the model, like, oh, I think that's going to happen, but I want to dial that back a little bit further just in case it doesn't. Suddenly you pay $1 million less for the project and somebody else can pay $1 million more and you don't win the deal. So very, very opaque forward-looking assumptions in our always incorrect models these days. And I think that's thematic across a lot of industries right now. That was a total
I think
random
you're
thought
not
and
alone. You're
digression.
not.
Forgive me. Maybe as an expert podcast host, you can put the
This
rope
is good.
back on me and get us back
You're
on
about to say
track.
something about North
Yeah.
Carolina too.
Yeah. Tell us more.
Yeah, that's North Carolina, but we've had a lot of success. I know it's kind of a cliche at this point in real estate finance, but we've had a lot of success in these tertiary markets. Markets that are outside major MSAs. We're not talking like cow towns necessarily, but an hour west of Charlotte or an hour east of Atlanta. Like Atlanta itself has gotten crushed with new self-storage supply. We have a town called we have a property in a town called Tequila that's east of Atlanta, like 45 minutes, and it's killed it. So I think if you're outside the periphery these days and you're being careful about supply ratios, secondary, tertiary markets are a good place to target. I think the reason those have done so well generally is they don't suffer from the booms and the busts of the primary markets, right? Like Denver, for example, we went through this. A lot of developers, including us, had the same idea at the same time in Denver, and we all delivered in 2018, right? A bunch of us, just all these projects came out of the ground. We all delivered. Well, big surprise, what happened? It was a race to the bottom from an occupancy and a rent perspective. But then supply ratios got more balanced, rents came back, and then it became time and it made sense to build again in Denver. So big shifts in the kind of supply demand pendulum in these more primary markets, and these smaller markets just don't see those more pronounced peaks and troughs.
Let's talk about technology. How are you guys using technology in the business?
I hate to even bring this up because everyone's talking about it, but obviously we're doing a lot with AI. One of my partners is a software engineer by training, and I'm a bit of a dinosaur to a degree with this stuff. Like I know how to run my computer and my phone well, but I was kind of an AI, I don't know, miscreant maybe 6 months ago. And I really took it upon myself to learn how to use these tools, and they're absolutely transformational. We're using AI for example, we were talking about our self-storage customer type a few minutes ago, and we have millions of data points in our portfolio that we've regrettably not used to our benefit as much as we could. So one of those, for example, is how often does that customer come and go from his unit, right? Because you can tell when they punch in and they punch out using their gate code. How many times does he visit his unit? Okay, he's there 5 days a week, and he shows up in the morning and he shows up in the afternoon. Okay, how far away does he live? Well, his address that we have on record is 3 miles away from the site, pretty quick drive. So this guy lives close. He's visiting his unit frequently. And let's say he's in a 10 by 20. That's a pretty big unit. He's probably got a lot of stuff in there. So could this customer sustain a rent increase better than a customer who's there on Christmas, right? To get their decorations in and out? And the answer is probably yes. So we're starting to apply a lot of our consumer behavior metrics into our revenue management algorithms to drive revenue more efficiently. We're also rolling out, it's kind of in the beta stage right now, but an AI call center where you can talk to a person that sounds like a person to make your payment, but it's not a real person. You could even get the person to use that submarket's kind of speech mannerisms or accent. So you guys sound like a bunch of bumpkins up in Milwaukee, right? Mechaniwak and you could have a Milwaukee Midwest accent, and in our Florida Panhandle customers, that's the deep South, even though it's Florida. So you can program these AI agents with regional dialects. So we're doing a lot with it, but it's still kind of in the early stages. But I would say the biggest impact that AI has had on our business and me personally is our ability to execute on complex tasks much more quickly, like do analysis of reams of data, like getting financials to bankers for refinances, portfolio performance analysis, charts and graphs. It's just remarkable. And this stuff is getting smarter every month. A new LLM will come out that's 25% better than the last one. It's obviously transforming the way we all do business, and we'll see if that transformation is going to create blood on the streets and massive unemployment, or just make our current roles and responsibilities more efficient and more productive, right? But we're doing a lot on the tech side. We also have a real-time investor reporting platform that has an API into our property management software. So as one of our LPs, you can log in, you could see any one of 25, 26 different KPIs at the facility level, the fund level, to gauge how your investment's performing and how your assets are performing. And we initially built this using the traditional software engineer route, but now we're maintaining it using AI. So a lot of bottom line savings there on paying software engineers when you can just kind of get in and typey and, hey, fix this line of code, roll out this new button in this new chart, and it goes and thinks in the background, and there you go. You have a nice graph and chart for your investors to look at whenever they want to log in. So we're doing a lot with it.
Yeah, that's great, Jacob. I know we talk a lot on the podcast and ask people about AI. I have some background in AI myself, but I'm curious. You were very skeptical. What you said earlier. What you started to test it yourself. That's really kind of changed your mind. Was that kind of the switch for you?
No, I wasn't skeptical. I just wasn't taking the time to train myself on it. I was using ChatGPT like anybody uses Google, right? Like type in a question, like just like a basic Google question. Like, oh, this isn't that cool. But when I started, test driving like Copilot and Claude and Codex and ChatGPT, and actually train myself on how to use this stuff. One recent example was I needed to give a banker global operating cash flows from our different operating companies, not our investor companies, but our opcos, right? They wanted to see our cash flows greater than 25%, 125% of our annual debt service on this loan we're refinancing into. And manually doing this, I could do it. It would take me hours, and it would probably be kind of a crappy product. I dumped 7 different P&Ls in and 7 different balance sheets, gave it a few prompts, and 10 minutes later, it came back with a beautiful spreadsheet by year of our net income by operating company, with a debt service coverage ratio calculation by year, a description of what the operating company does, and then all of it rolled up in a consolidated format. And I could have paid an MBA to do this, and it wouldn't have come out as good as it did. So yeah, it wasn't that I was resistant or skeptical. It was more just that I wasn't taking the time to learn it. And now that I have, I mean, I've scratched 10% or less of the surface of what the stuff can do for me personally within our business. But my partner is spending a ton of time. Big tech guy. If you walk into his office, he's got a dozen different terminal windows open on his Mac, just doing crazy stuff. But it's remarkable. I mean, I can see the visceral, real world examples of how much time it's saving me and how much more efficient it's making my role in our company. I can't imagine if I had like a software engineering brain, how much more I could do with it.
Yeah, no, it's definitely exciting. Kind of going back to what you said about, taking back the management process of your storage units, right? Similar to what you're talking about here, taking back that. And I totally believe, this is just my opinion going forward, that many companies will have their own custom software solutions in-house that they built on the backs of AI in real time, just to have to do.
Oh, software as a service
Yeah.
is in trouble.
That's right.
I mean, you can go out pretty soon, if not already, a civilian could go out and replicate whatever software as a service they're paying for, whether it's a CRM, a data source like self-storage rent analytics. I mean, you can build it yourself pretty easily these days, and even more so in the future.
100%. I totally agree. Very exciting.
Jacob, before we let you go, we got to talk about the fun stuff. You mentioned the word meth twice. Let's hear like the craziest shit you've seen in these storage lockers.
I'm not sure if you can see me, scratching my
It was you.
scratching my neck right now.
Storage awards.
So well, I've seen a lot of crazy things, and the two reasons I've seen a lot of crazy stuff is I was in the fire service for a while. I was also I've also been a real estate owner operator for 20 years. So the stuff we've seen between both is like the most depressing parts of human nature, right? Between real estate and emergency services. We had storage units underneath our office for a period just to kind of offset our overhead. We were having too many homeless issues, so we ended up changing those to an industrial tenant. But I've got a video of the cops holding a dude at gunpoint in our parking lot. There was, high as a kite on meth. He wasn't cooking in the unit, thankfully, but had a bunch of stolen stuff. And this guy reached in his pocket, and I was thinking, dude, don't reach in your pocket right now. You've got 3 cops with their Glocks on you. Reached in his pocket and pulled out a meth pipe and threw it over the fence, thinking that the cops wouldn't see it. Thankfully, they didn't assume he was pulling out a weapon. But we get occasionally served DEA search warrants, not because we're doing bad stuff as the owner, but your drug lords are keeping bricks of coke or bricks of cash in their storage unit. We once had a homeless gentleman get a pizza delivered to his storage unit downstairs when we had storage units underneath our office. We're hanging out in the parking lot one day in between meetings. It was a nice day, and this pizza guy shows up. Like, hey, you guys order a pizza? We're like, no. What's it say on there? He's like, unit 203. And eventually we figured out that a homeless dude was hanging out in his unit. Obviously
This was his
ordered his
home.
lunch. So occasionally we turn into residential landlords and not self-storage landlords, even though we don't mean to.
Wow.
But our operations team, we've had people get stuck inside their units. We should make a YouTube channel with our security footage on just, humans not being intelligent. We've got plenty of that too, but, lots of war
we've all
stories
seen
out there.
the
for
TV
sure.
show Storage Wars. I think some of that's fake. Probably this is like a little bit of an older show, but you guys ever cut open any units that aren't paying, and you guys see some gold in there or what?
You're correct. Like any reality TV, a lot of that stuff's planted. We did have one customer who went to auction who had a really valuable Lionel train set. Like apparently, to 100 people in the world, it was worth like $100,000 or something. So occasionally we'll see that, but it's rare that we auction somebody's contents. And we actually get more proceeds from the auction than they owe in rent. It's pretty few and far between. Yeah. I'll have to ask the team to see if they've seen anything cool lately, but no
worries.
great stories there. No bricks of gold.
No bricks.
We've covered a
You
lot.
never know.
And anything you want to talk about, like, is, next couple of years, what you see that you're excited about, or what's next for VanWest?
Yeah, I'm excited at the idea of, as long as you're on the right side of it, I'm excited at the idea of some potential pain coming in the market. Now, you want to be on the right side of that pain, but we've historically done very well during times of pain. Like we bought a bunch of deals during COVID, and little did we know how much, the real estate market would do after that. We bought a bunch of deals back in the GFC. But I think this environment needs some moderation. There's got to be a little bit of water poured on this fire because it just can't sustain. The stock market, granted, real estate values are kind of challenged depending on what asset class you're in, but given the pace that we've seen interest rates increase, I would have expected much more of a material and measurable decline in asset values. We're just not.
Awesome. Well, Jacob, this has been a lot of fun.
Absolutely.
Where could we send people to connect with you and learn more about VanWest?
Always love to talk shop about real estate. People can email me, Jacob at VanWestPartners.com. Go to our website, VanWestPartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Awesome. Well, this has been great, Jacob. We'll make sure to include all your content info in the show notes as well.